I think there's going to be a big shift in the asset management industry, particularly around this private equity outsourcing. The internal models really are expensive to operate. You need staff, you need technology. The LPs are demanding more and more reporting, quicker reporting, more sophisticated reporting. And it's very difficult to do that if you've historically done it on Excel with systems or teams that are used to doing it in a certain way. So the investors are looking for more, essentially. And Source solution is really going to be a big change over the next 10 years in this industry, as 70% is still insourced now, out of 3.8 trillion. So if you think about that reducing down to maybe 20% in 10 years' time, that's a huge shift of assets moving from insource to outsource. But there are very good reasons for it. There's a big expense overhead. If you've got 10 back office people and you're a mid-tier GP, whether you're in San Francisco or whether you're in New York or whether you're in London, those people are expensive. They're using expensive real estate, and the cost of living in those cities obviously is applied to the salaries you have to pay them. And it's very difficult to pass that on to a fund structure. So if you have a more sophisticated technology solution with an outsourced staff in a lower cost environment, there's huge savings, and it's really demanded now by the investors as well. GPs are looking to, in some situations, outsource as much as they can. They want to find good projects to invest in, and they want to raise money. That should really be their focus. So in many cases, they're not just outsourcing the fund reporting, but also the underlying SPVs reporting, all the tax work, even their own GP accounts can be outsourced. So they're looking to move as much away as possible because they see the efficiencies and the cost savings, as well as having the better technology, and also independent control over bank accounts and things like that is very important to the investors. I think that it really will have a drag on raising capital for Fund 2 and 3 if they're already in Fund 1. If they want to see you evolving as a business, becoming more sophisticated, giving them better reporting, because they probably get that from other GPs that they invest in as well. So you've got to keep up with what the competition is doing, otherwise you're not going to raise the capital and be successful. Also, if you're still doing things on Excel, there's a possibility of mistakes. So you want to have a sophisticated straight-through process, giving nice dashboard reporting to your investors. And if you have an urgent capital call to make, are they there? Are they on vacation? Are they sick? So again, you don't have those problems if you outsource. It is to make sure your vehicles are in the right domicile to be attractive to the LP investors. So some may want it to be in Cayman, some may want it to be Delaware, some may want Luxembourg or Ireland. So you have to have that flexibility to be able to offer the right domiciles for your investor base. You don't want to have your administrator creating hurdles for you by saying, oh, we can't service in Luxembourg or we can't service in Ireland. You want your administrator to be an asset. And they have to be in those places so that you can raise as much capital as possible and not get in the way of you being a successful general partner. It's successful for the big GPs, but I think below that level, it's still hard to raise money. We're seeing a shift, in assets moving from hedge fund classes into more illiquid classes, private equity, uncorrelated investments, as well as people putting together hybrid funds as well, with a mixture of liquid and private equity type investments. So we're seeing those sorts of shifts. Yes, they are raising money, the big ones, and therefore they need to keep pace with what their investors are requiring in terms of the sophistication of the reporting. So they don't want to just hear how well they've done, they want to know how your portfolio is split between types of investment, geographical analysis, so they can really understand what the portfolio risks are and how it's put together. LPs looking to go direct or co-invest rather than going through fund vehicles is a big change. Historically they used to say, we'll trust the GP, we'll have an allocation to their fund, and we'll trust them that they're going to make the right allocations. Now, many LPs are looking to not just invest into fund vehicles, but go deal by deal with the GPs. And that does require some more resource. It's more complicated, and we've had many clients come to us and say, we've done these 20 deal by deal transactions, but how do we know that the carry is correctly calculated? Are we calculating it? Are they calculating it? So in many ways, it's good to have someone independent, in particularly in those situations when you're going deal by deal and there's just two of you in that deal, to make sure that the carry calculations and the internal reporting is done correctly. I think it's making it harder to find the right deals. Certainly more pressure to find good deals, and there's more competition around deals when some of the big pension funds, the sovereign wealths, they have that sophistication now to go direct rather than through a GP, and that's making it more competitive, I suppose, for the good assets that they're both looking to buy. I mean, the GPs have got to keep evolving. They have to have a reason to add value, and if they're providing sophisticated reporting on a timely basis, then the LP is seeing that they're getting everything they need from that GP, and they don't have to go and try and recreate it themselves. They realise recreating it themselves is expensive. They have to have a team to manage it. They have to have a team to source the deals, have to structure the deals. So if they don't have to do that, they prefer not to. So as long as the GPs have the right infrastructure and the right levels of reporting and the timeliness of it and the quality of it, as well as the GPs price correctly as well. So I think some of the LPs may be going direct because they're feeling that the GPs might be charging too much in some situations, the carry might be too high. So your GPs are going to have to show some flexibility as this evolves. I think there hasn't been that pressure until recently. They've been delivering good numbers, and as long as you're performing well, your investors are happy. They don't look at the details, and maybe the reports aren't in a beautiful format and they're not giving the drill down on analytics that they would like, but because the numbers are good, they aren't creating a fuss about it. And many of these GPs have evolved over time, and they've hired locally and they've had big teams in-house as they've grown and expanded, and that was the norm then. But we're seeing a lot of people now shifting and looking to outsource, but with that they're lifting out their teams that were historically in-house, and in many cases they're moving to the administrator as well, so they have the continuity. They're giving a solution to their staff, so the staff aren't being laid off, and yet they're evolving and moving away from the historic model, which investors aren't interested anymore. And there are two real software solutions that give great reporting. There's Investran and there's eFront. They've really taken it to a new level in terms of the analytics you can get from your portfolio and the dashboard reporting that the LPs can get. And that's evolving, and they're investing huge amounts to make sure that they're not just good for now, but they're good for where the industry is going to be in 5 years' time in terms of what the investors are looking to see. 5-10 years ago, there wasn't that level of sophistication in software for the private equity space, because everyone was happy with it being done on Excel or Excel versions. Now the expectations have changed, and it's great that there are good solutions on the technology side out there which are able to deliver what the investors are looking for. They are accessible, but currently it's only the larger GPs that can afford them. It's not just a question of paying for them, but training the people to run it, paying the maintenance, upgrading it. It's a big investment. It's a very worthwhile investment, and I think the companies I mentioned are having a lot of success in terms of getting the larger GPs to take in their software and give the analytics internally that they need. And therefore, we find that being an administrator that's able to support and have matching technology to what the large GPs have, and maybe even supply the same sort of skill sets to the mid-tier GPs who don't want to spend, whatever that is, it's $500,000, $1 million. These are big numbers and make a big difference to a GP's P&L, as well as having to operate it and having the staff to operate it. So if they can get that through their administrator, the same quality of reporting, then they look like a big GP, and then they can raise extra assets for funds 2 and 3. So I think it's really key that people realize it doesn't have to be expensive if you outsource, and yet you're still looking like you're giving the detailed reporting that the investors are looking at and looking for, and therefore you're still able to attract capital. It is the biggest challenge, and the sophistication of these cyber attacks is incredible. I just went through our internal training last Friday, and the things they can do terrify me. GPs aren't recognizing it because they're happy doing things the way they've always done them. But this is a whole new phenomenon. Even with a strong cloud support, you still will come under pressure. But if you're just a GP with your server in your office, it's a huge threat. I think the big difference with general partners, having a server in their office and the potential for that to be attacked versus a third-party vendor that has several hundred clients and is cloud-based using an experienced third-party provider to protect that cloud. It's massive, the difference, and business critical to both businesses, but the business that has several hundred clients to protect is obviously able to spend a lot more money on it and obviously be more aware of the threat. So I can only express how important it is to general partners that haven't addressed this to really consider it very carefully, and as a minimum make sure that your information is securely held on the cloud. The cloud provider is spending a huge amounts of money each and every year to protect you, and can protect you much better than if you have your own server with firewalls. I've been looking at how that's affected our firm internally and whether we have any exposure to this. And really it's sort of more of a wealth management tax planning phenomenon. It is about having the right structures for tax efficiency and in some cases tax avoidance and things like that, which is really not what private equity is about. Private equity is about structuring vehicles, commingled vehicles, to invest into projects or companies or real estate. They're two different things. One is individual tax planning, and the other one is creating vehicles that will actually grow and be profitable and successful. So I don't think they're connected in any way, and we haven't seen any difference to our business on the private equity side. I think it's made a big change and more opportunity in the debt space. You're seeing peer-to-peer lending vehicles really growing and filling that gap, not just in the US, but also globally. We operate a peer-to-peer lending vehicle out of our Dubai office, for example, which is very successful. So that level of lend that the banks aren't really covering so well now is an opportunity for the peer-to-peer lending funds, and even crowdfunding and other vehicles are getting involved in that space. It's changed the dynamics significantly, but it's creating good opportunities for people, creating fund structures around that. And it's not just a US phenomenon, it's even happening in our office in Australia. We're talking to several opportunities like that. And there will be a standardization, I think, across the industry. It's coming slowly. It's been standardized in terms of the reporting requirements on the open-ended and the hedge fund and the fund of funds side for many years. But that hasn't happened yet on the private equity space. So the investors are driving that, and the due diligence requests from the investors and the investors' consultants are driving that, and there will be a standardization across the expectations of the reporting and how reports are delivered and the requirements of ILPA, for example, and the standard formatting of reporting. And that's really important to standardize it across the industry, because then investors can know exactly what they're getting and what they're looking at, and making sure that each GP is apples for apples in terms of when they're compared to each other, whereas historically that may not be the case. 3 years ago, we decided to have specialist centres because we were finding that being more of a generalist, which meant we covered hedge funds and private equity, meant that we were able to do some private equity, but not the level of sophistication that we needed to really deliver a great product. So we invested in using eFront as our specialist solution, which is very proactive and looking to be leading the way in terms of the solutions that LPs can be given in terms of the dashboard reporting. And we've tied in a web-based front end to that as well, so the investors can come and get the information whenever they need it. We've really worked hard to make sure that we have as credible a solution on the private equity side to compete head-to-head with the private equity-only administrators. But our advantage is that we are in 6 different jurisdictions globally with these centres. We cover 24 different domiciles in terms of structuring, both for structuring the fund, but also the underlying SPVs. And also we find that more and more demand for hybrid solutions. So the specialist hedge fund only administrators can't do hybrids very well, and the specialist private equity only administrators can't do hybrids very well. So less than a handful of administrators globally have got that sophistication where they've invested in technology for the private equity piece and the technology for the hedge piece, and put it together with a nice web portal packaged around both. For example, there may be a US manager that's looking to invest into some hotels in Australia. Well, we're having an Australian office and having a US office, we've actually been able to give them a great seamless solution, which they're really pleased with. That's the benefit of having 33 offices around the world and 24 service centres, but 6 specialist private equity centres as well. It really adds a lot of value. To do private equity well, you have to have people that all they've done is private equity. You can't have someone that's doing a hedge fund or a fund of fund one day and then they're picking up a private equity fund the next day. It's totally different in terms of the accounting, the terminology. So you have to recruit specialists that have been doing this all their lives. And that's why we have the team leaders in each of our centres of excellence. They have all they've done is private equity. And they've used eFront for many years as well, and they've got experience with doing listed funds onto the London Stock Exchange and capabilities like that. And so we're using them, and then we're obviously investing a lot in super user training of the technology throughout all our offices. You have to invest in the training to make sure that you pass that skill set through the organisation. And so it's a combination of getting the right people as well as training them well. I find it strange that in some places private equity administration can be so expensive. It doesn't need to be expensive. It's usually a fixed amount per month with a little bit extra for capital calls and distributions and a little bit extra for financial statements. And if you have the right technology, it's pretty low touch. So I find that some of the models of our competitors are probably twice as expensive as they should be. And so we can be very disruptive in terms of the cost in some markets around the world. And in other areas, you don't have very many really specialist administrators at all. Whether you look at Asia, there are 2 or 3. In the US, there may be 5 or 6. I'm talking about the non-bank models because they're the ones which are more flexible and more adaptive and able to support the mid-tier market. The bank models are more really focused on the massive GPs.